Good morning and welcome to the Killik & Co market update. This week we've had the moment we've all been waiting for, and the Federal Reserve has finally cut interest rates. There had been some speculation over whether the Fed would cut by 25 basis points or 50 basis points, and in the end the central bank opted for the bigger cut. Here's where the rate stands now in the context of the last 5 years. Markets could have gone either way. A big rate cut is helpful to the economy, but investors could have reacted negatively to the fact that the Fed thought such a big cut was needed. In the end, markets reacted well, and we saw a new record high for the S&P 500. We saw an increase in confidence after the rate cut too, which we can measure by looking at the CNN Fear and Greed Index. The index uses 7 different measures to gauge whether investors are feeling fearful or greedy, including the level of momentum in the stock market and the level of demand for safe haven assets. The index can be between 0 and 100, and it's currently at 67, which puts it firmly into greed territory. Here's how it has moved over the last year. You can see it was in fearful territory just a couple of months ago, but sentiment has recovered very quickly. There's been some chat in the financial press this week about European stocks and whether they deserve more attention due to their low valuations in comparison to US stocks. Here are the current price-to-earnings ratios for the different MSCI regional indices. 21.1 for the US and 18.4 for the US if we take out big tech. The US has always been more expensive than the rest of the world, but then it has significantly outperformed despite this. The All Countries Index is at 17.5, and then Europe is significantly cheaper at 13.3. It's worth bearing in mind that the US makes up 63% of the All Countries Index, so the valuations in the US do have a big impact on the valuation of the global index. Here's a comparison of the MSCI World Index to the MSCI Euro Index over the last 20 years. The global index has significantly outperformed because it contains all those big tech stocks that have driven the market higher. However, the European index has picked up more recently. Here's the data over the last 2 years. So the Euro index is ahead over this time period. The term Magnificent Seven has long been used to describe 7 of the most successful stocks in the US: Apple, Amazon, Microsoft, Nvidia, Alphabet, Tesla, and Meta. An equivalent for Europe is the Granolas: GSK, Roche, ASML, Nestlé, Novartis, Novo Nordisk, L'Oreal, LVMH, AstraZeneca, SAP, and Sanofi. If you look closely, the first letters sort of spell out granolas. We do have a few granola stocks on our cupboard list, so do give us a call if you'd like to chat about them. And lastly, India's weighting has overtaken China's in the MSCI All Countries Index. We often talk about the MSCI World Index, which is our preferred global benchmark, and it focuses on developed economies. The MSCI All Countries Index includes developing economies as well. Here's the current country breakdown of the MSCI All Countries Index. This is based on the value of all the stocks on each country's stock exchange. As mentioned earlier, the US dominates with 63%. In the bright green, we have India with 2.4%, and then in the pink, we have China at 2.2%. Here are the MSCI China and the MSCI India over the last 20 years. For much of this time, they have tracked each other, but since 2020, there has been a huge divergence. China has plummeted for many reasons, including the property crisis and the impact of tariffs. Whereas India has done well for many reasons. It's becoming a global manufacturing hub, and it has a very big population, a very young population, and therefore a very big workforce. Please do give us a call if you'd like to talk about the two economies in a bit more detail. Moving on to have a look at next week, we are expecting results out from Accenture and Costco. That's it from us. Have a great weekend, and we'll see you next Friday.